Okay, it's 11 o'clock. Let's get going. On the news front, I'm going to make Richard do most of the work this morning because there's a lot of property news, but I've got a couple of things to talk about. But our guest this week is Ed Hunt from Hickle Infrastructure. It should be interesting. So, news first. I'm talking about Marble Point and Odyssean, and then I'm going to hand over to Richard. So, Marble Point first. This is quite an obscure fund, I think, for most people, and so I won't dwell on it too long. It's a structured debt fund, so it's invested in debt, but through a series of structures that gear up the income. And as you can see, it's actually trading at a hefty premium at the moment, but it's not very big. It's only $125 billion market cap. It was launched in 2018, and about 4 years after that, the board said they was going to introduce some kind of liquidity mechanism to allow people to get out if they wanted to. And the way they do that is quite convoluted, but basically, every 2 years, you have the opportunity to convert your ordinary shares into liquidating shares. They go into a separate pool of assets. The liquidating shares aren't listed. And then they turn those assets into cash and hand you the cash back over time. So the first pool was created in January 23. It was capped at the maximum, so 25% of the share capital, so 49.7 million shares in that pool. And they've been gradually selling off bits and returning cash for that. And there's another opportunity in December this year. So there's one coming up quite soon. And if you'd imagine that the 25% will go, then that will be some $100 million fund, which is going to be quite small already. Nevertheless, one of the big shareholders wants to kind of accelerate that process. So they called an AGM in January and they said, let's have this opportunity every year, but let's make it for as many shares as people want to get out at. And then they just tried to speed up the process of having the cash back. This thing about approving disposals just seems really cumbersome, though. I think that will just slow down the whole process, but there we go, and make it more expensive. The board wasn't happy with this idea, so they said don't vote for it. And part of the thing is that they're saying they're trying to put people off opting for the liquidation pool because once you're in there, you can't get out again, and you can't trade your shares, and it could take up to 7 years, or at least 7 years, actually. They say to turn your pool into cash completely, and that's because the structures they're invested in, they can't break them. They have to wait for them to mature naturally. There is some secondary market in these things, so they could try and sell some, but there's no guarantee they'll be able to do that. There's also a wrinkle around the debt too. I think they might have sorted that out. When I looked in the accounts, they were talking about 30 million quid of debt, I think, when this was happening, but when the accounts came out later on, they penciled that down. So it said, well, if you say yes, you'll vote for the freestone proposals, we want the ability to put everything into liquidation and put the company to manage wind down. So you have to vote on that too. And when they had the EGM, these things all needed 75% approval, and we didn't quite get there. So for the freestone proposals, it was 65-35, and for board proposals, it was 55-45. So as far as the board was concerned, that's it. But obviously, that's quite a sizable vote in favour of, like, please can we get our cash out? And so Freestone has called another EGM, and I think, although there's nothing on the screen yet, that it's just exactly the same select proposals. They've got just shy of 26%. Some of this is all double counted, so that this Freestone senior loan will probably be in that number. It's a quite concentrated portfolio, I'd register rather. So I'd imagine that there's a reasonable chance that it will go through. We'll have to wait and see. I'm kind of at the point now where, given that 65-35 vote, the board should probably just say, this is daft, let's just put it into managed buy down anyway. But there we go, we'll see. Odyssean then, very quickly, they can't do the show next week. They had an issue with their compliance director where they said he couldn't do a live show. Sometimes these people times are up in lots, we can't really help that. It might be around the fact that they're just trying to put something forward to shareholders to approve. So They are 7 years old now, and so they promised people an exit opportunity after 7 years. So they're going to do this via tender. It's an unlimited tender. You'll be able to get out at any less cost. So same sort of process we've just been talking about. So put everything into a separate pool and then liquidate that pool. And they're saying, if too many shareholders want out, we'll propose something more drastic. So we'll pull the tender and do something like a managed wind down as well. I think that's very unlikely. For the first thing, it's trading at a premium, so 1.1%. It's also performed relatively well. I mean, I know this looks like a really boring chart, and it has just gone sort of sideways for a long time now. But that is the UK small cap market for you. And actually, within the UK small cap market, it ranks 3rd out of 23. And the only things that have outperformed it are the two stablemates, so Rockwood Strategic and Oryx. So it's really quite a decent track record, and it's a reasonable size as well. I would think that not that many people will tick the box, because obviously you've got the option of just selling your shares in the market at a premium anyway. So why take NAV when you could get a bit more money this way? So that's Odyssean. Let's hand over to Richard.
Right, thanks, James. Yeah, so like I said, been a busy week. I'll start with abrdn European Logistics. So this chart isn't too dissimilar to a lot of the property companies actually. So obviously towards mid 2022, interest rates started picking up and obviously value started falling. So it's moved to quite a wide discount. It's on about 25% discount at the moment. So they launched a review at the end of 2023 to sort of, ahead of a continuation vote and to sort of see what their options are. And it obviously faced them quite a lot of challenges. The main one being the uncovered dividend. See, we talked about the wide discount. It's also too small, and I mean its earnings have been hit mainly because of a few key vacancies in their portfolio. So they bought a big sort of portfolio in Madrid right at the top of the market, paid sort of sub 4% yield on it, which seems disastrous now. Well, it has been disastrous. And very quickly, one of the tenants went bust. That was a rival, which is like an EV company. And they've just been sort of scrambling ever since to try and fill that void. And they've had a long-term void in one of their French properties as well. So they've this week come to a conclusion of that strategic review. So they indicated that they've received about 11 offers or indicative offers for the company, all that they said were too low to accept or take forward, below NAV. And their managers also put forward a proposal for a sort of managed wind down, and that's what the board has opted for. So they're recommending shareholders to vote against the continuation vote at their AGM later in June. And they obviously believe that that they can sell these assets and generate more money than what they could through the offers that they've had. So they say, yeah, the vacancy is about 6.5%. So they'll look to obviously let that up before they sell them. And they also said that some of the bidding parties indicated that they were interested in certain portfolios, smaller portfolios within the wider portfolio, which they say gives them confidence that these sales can be made. They believe that the majority of this portfolio, there's 25 assets in there, will be sold by about a year's time, which would be good going actually. And they forecast a lower interest rate environment going forward, which would help the investment market and help them out. So we'll see how that goes. It seems it is going down that road. Like I said, vote in about a month's time on the continuation. So that's Asley. Also fairly big news, M&A again in the sector. So this time NewRiver REIT and Capital Regional. So announcement yesterday. So two bids for, or two interested parties for Capital and Regional. So NewRiver approached their largest shareholder, which is Growthpoint, about a possible offer, and Capital and Regional also received an offer from Bukil, which is a sort of South African REIT that does shopping centres. It also owns something in a REIT in Spain as well. So, and they're also considering an offer. So, what's more sort of interesting to me is the NewRiver REIT one, which I think could work really well. So Capital and Regional is quite small, but so I'll go through what they do. So they own 6 shopping centres across the UK, and they call them community shopping centres. So they're the smaller sort of secondary ones, not the big sort of lakesides that you'll see, but smaller ones. They're more aligned to sort of essential retail and value retail. Occupancy's pretty high, sort of 95%. They had 3 stores let to Wilko, which obviously went bust earlier this year, but they quickly relet that space to B&M. Footfall has been gradually going up since the pandemic. It's now sort of 87% of pre-COVID levels in 2019, so still a bit of work to do on that side. But rents have been going up. It's been a sort of rebasing of rents over the last sort of 5 to 10 years, as people probably would know, and now they seem to be on a upward trajectory. So nice earnings growth there. Valuations also seem to be on an upward kill. So that's Capital and Regional, and then NewRiver also owns shopping centres, but have got a bigger portfolio in retail parks, and it also has an interesting sort of revenue stream where they partner with institutional funds and basically manage the assets for a fee, and that's the side of the business that they're trying to grow. So that sort of sets them apart. They've had a turnaround strategy over the last 2 or 3 years, where they've sold a lot of their non-core stuff, strengthened their balance sheet, and now got a comfortable LTV position of up sub 30%. Occupancy is at its highest level they've ever had, at almost 98%. And their chief exec, Alan Lockhart, recently said that he's seen the occupation market the best it's been in the last 5 years. So they're positive on the sector. We saw them a few weeks or a couple of months ago now, and they indicated that they're really looking to grow. So this would be really interesting for them. So the combined group, if it were to go through, would be made up of 42 assets, and these companies are really aligned, which can't be said for some of the mergers that have happened recently. But these portfolios seem really in tune with each other. So it'd be worth about 920 million. Market cap is obviously really low for both companies, but combined would be about 360 million. And they reckon the cost synergies and earnings growth that they can get would mean a materially higher and covered dividend going forward. So we'll have to see what happens with that. There might be other parties come forward over the next couple of weeks as well. And then, well, busy day yesterday, because we also had an announcement from Great Portland Estates, which is the London office developer, of a rights issue. So looking to raise 350 million. It's fully underwritten, so free shares for every 5 at 230 pence, which is a large discount to their closing price of a couple of days ago. And they're doing this because they see massive opportunity in the sector at the moment, to acquire offices mainly in the West End and Midtown of London, at bottom of the market prices. And they say they've not seen this sort of level of undervalue since post the global financial crisis. Have they hit the bottom? Not sure, but I think we can safely say if it's not at the bottom, it's very close. And there's been a lot of research on supply in London and how that looks over the next few years. And Helical was talking about this yesterday as well, that there's going to be a real squeeze on supply in London offices around sort of 2026, 2027. So this is what they're looking to take advantage of, because it takes about 2 to 3 years for the whole sort of development cycle to bring something forward. So now is the time to be sort of going through that process. And despite all the noise about working from home and things like that, the occupation market is still really strong in London. It's a sort of two-tier market. There's a lot higher vacancy in the city, but in the West End, it's really tight vacancy, and that's where Great Portland really sort of focuses its portfolio. And their vacancy rate is 1.3, which is very tight, and you can see the growth there and their rents that they've had over the last year because of that. And this isn't the first time they've used a rights issue. So they did one right after the great financial crisis in 2009. Perfect timing, as I think they've suggested they're looking for now, would be perfect timing as well. Depressed values, acquiring at the bottom, developing into a sort of rising market, and then sell them on in a few years' time. So in that cycle, they managed to achieve 30+ sort of profit on cost on their developments, which would be what they're looking for this time, I would have thought. So they're looking to the rights issue would increase their investment capacity. So they've already got about 100 million. So this move it up to 450. They've got a near-term pipeline of acquisitions of 1.4 billion and a sort of further 1.4 billion that they're looking at. So there's a lot of work gone in on potential assets that they can buy. So about 170 million will go into capex into 2 of their current assets, so Soho Square and the Courtyard, which they acquired recently. The remainder will go on new acquisitions over the next year, and they've also looking to sell some more assets to fund this pipeline as well. So yeah, I'm quite excited about this one. Rights issues sometimes, well, it's got a bad name because they're sometimes used for because of poor balance sheets, things like that. But I think in this case, it could work really well to their advantage and to shareholders' advantage as well.
Great. Thanks very much, Richard. Covered a lot of ground.